Saturday, February 13th, 2021, Monaco 64, home of alternative economics and contrarian views. So Janet Yellen told the G7 that the time to go big is now. What does that mean? Well, it means more debt, more deficit spending, more money printing. And are you surprised? If you've been listening to me for the last few years, they can't stop. Once you get on the road to inflation, once you start money printing like the powers that be have been doing since '08, you can't stop it. Yes, they tried to normalize it a few years ago, and Jay Powell learned very quickly that he had to reverse or else everything was going to implode. And I've noticed as well that despite the fact that the general market yesterday, the stock market was very quiet, except for a mini rally towards the end to make it the markets look positive. Yeah, markets are very quiet, but I noticed that bond yields, treasury yields, spiked. Yeah, not a great amount, maybe 4 or 5 basis points in the 10-year, 6 or 7 in the 30-year. But some of you know that my specialty as for my profession in the city on a professional basis, I was a bond guy. I covered the bond markets, specifically government bond markets, for over 20 years. So yes, I know what I'm talking about when it comes to the bond market and to yields. Precious metals have been more of a personal thing for me. I looked into it on a private basis, on a personal basis for over 20 years, of course. But yeah, I can tell you that it was weird yesterday prior to the stock market closing. I think an hour or two before, they were pretty flat. I think the Dow was down a little bit, not doing anything, the NASDAQ nor the S&P. And I noticed that the 10-year yield had crept back up to key resistance level, the high of the year that we've seen at 120, 1.2%, as you can see here. So we closed a week on the highs here at 121. And the same thing for the 30-year. We closed above 2% at 201. And I think that's got everything to do with the G7. And I covered that, I think it was Friday last week. I said the Zoom Accords, because this G7 was hosted by the UK finance minister through a Zoom conference meeting. And I compared it to the Plaza Accords back in the mid-'80s when they met, the finance ministers and the central bankers. They met to put a halt to the dollar's strength, and they were successful. So it says Janet Yellen signals U.S. return to multilateralism in first G7 meeting. Treasury Secretary urges continued support for global economy. The time to go big is now. And it means more fiscal largesse. Not that we haven't had a time to go big since March last year, right? So it's crazy. It's not going to stop. As I've said, I've been warning you about this for years. The only way they're going to stop is when the whole system implodes, when people lose faith and confidence in the fiat currencies, the dollar and all the rest. So let's go quickly through this article here. Janet Yellen used her first G7 finance ministers as U.S. Treasury Secretary to signal a revival of American multilateralism in a clear change from Donald Trump's administration, according to officials who watched the video conference on Friday. So I'm going to skip a few things that are not really related to what we're really covering, which is the fiscal debt situation, the currency situation. So it says here, with the coronavirus pandemic still ravaging the global economy, finance ministers, well, I would say it's not the pandemic that's ravaging the global economy, it's politicians by locking our economies down for a disease that's really over 99% or 99.5 or 6, depending on the age, of people who get infected survive. It's been really exaggerated reaction that's really sunk the world economy, not the pandemic itself, right? But anyway, finance ministers stress the need for continued economic support. Yellen told the rest of the G7 not to cut fiscal support this year, saying the time to go big is now. That's a quote from her. Not surprisingly, it says here, her call was warmly received in the European capitals. So, yeah, I'm not sure about the UK counterpart. UK will probably join the party. They've been trying to pretend that they're worried about the fiscal situation, but believe me, they will join the party. The other thing I noticed that is a little bit worrying for, I would say, the emerging market countries, or as they call it now, low-income countries. They keep changing the name, the definition of these countries, all the political correctness. Anyway, it says the U.S. is revealing whether to back a plan for the IMF to allocate up to $500 billion in special drawing rights to its members. Well, these are SDRs. No, I'm not saying there's going to be a reset and the SDR is going to be the global currency, because the SDR is just a basket of the major currencies like the dollar, the euro, the yen, the pound, and a few others. And it was created, I think, in the late 60s when they had the problem with the dollar, when the gold was flowing out of the US. They wanted to create like paper gold, and they created the SDRs. It's basically another derivative of fiat currency. But who's going to pay for that? This 500 billion, where does it come from? Well, it comes from the countries from which they take the basket of the currency. So the US taxpayer is going to be on the hook. They're not going to tax you directly. It will be the inflation tax. Your currency will become more and more worthless. Same thing for the pound, the euro. So we're transferring your wealth to the low-income countries. Is that a good thing for the low-income countries? IMF running this kind of operation? I would say no. Just a few years ago, I think 2017 or 18, before Christine Lagarde, who I've got here in my ECB mug, you can see here, you can get one of these. She's behind bars. Why is she behind bars? Because she was convicted in a special court in France to 1 year in jail. But the sentence was, of course, they didn't make her serve it. She went back to being IMF managing director. She arranged a huge loan to Argentina, over $50 billion, and a year or a year and a half later, Argentina was in ruins again. Now they want to arrange $500 billion here to these low-income countries. Well, this is John Perkins, economic hitman, in action again. They're trying to entrap these low-income countries or emerging market countries with $500 billion more in debt. It's a trap, guys. To all those finance ministers from low-income countries that might be listening to my video, and I'm not sure, I'm sure not many of them are listening, but if you are, say no to the IMF. This is a trap. So that's what they're doing. We are all going to pay for this. The people who are going to benefit, of course, are going to be the bankers, because who do you think will arrange the loans from the IMF to these countries? Well, it's going to be the JP Morgans of the world. So yes, I think together with the commodities markets, as we've seen, and all this fiscal largesse that's going to continue, And believe me, the central bankers were there at that meeting yesterday. And if they didn't think it was the right thing for Yellen to say to go big, they probably would have maybe made her tone down her, statement, and they didn't. So they're going to be there with a printing press, right? And if you look at commodities, yes, we're continuing to surge here. Yesterday, of course, silver held on quite well. I would say gold was kind of weak early in the day, but it rebounded relatively well. So yeah, as you can see, commodities are continuing to go up. As I showed you here, the 30-year yield is going up, the 10-year yield. And the other thing I noticed the other day, Tavi Costa, who I've had on the channel before, he puts out some really good charts. And he put out this chart, global negative yielding bonds. So this is the amount of bonds that yield, whose yields are negative. And it was up to almost, I think, above 18 trillion by the end of last year. And now it's dropped by 2.4 trillion. So what does that mean? Well, that means that investors are selling these bonds, because when you sell bonds, the yields go higher. So if you've gone from over 18 trillion in negative yielding bonds and it drops by 2.4 trillion, it means that investors are selling. And that means that yields are going up. There's less negative yielding bonds. And why would investors buy negative yielding bonds? It might seem counterintuitive. Well, I'll tell you why. Because if you're a professional money manager, a fund manager, or hedge fund manager, and you see, let's say, the German 10-year Bund, which is the 10-year government bond there. I haven't really followed it that closely. I used to trade a lot of futures in the bonds, but let's say the yield is minus half a percent, and a speculator or a fund manager thinks that yield is going to drop to minus 70 basis points or minus 0.7%. They will buy that bond. So let's say the price is 150. So if they buy that and they think the yield is going to drop to minus 0.7, that price could go to 170. So they're playing the capital gains through the trade. It doesn't mean they're going to hold that bond for 10 years. But the other flip side of that is that once it turns, that trade turns, when investors feel that the yields are not going to keep dropping, they're going to try to rush out of that trade. Because the other thing about bonds is that the longer term the bond is, the duration, let's say a 10-year bond, is a lot more volatile and moves a lot more, is a lot more sensitive to interest rates than a 2-year bond. So a lot of these negative yielding bonds are longer term bonds. So this could create an avalanche of selling. And you have to understand, these people will use a lot of leverage as well. And why do they use leverage, you might argue? Why do they need to do that? Well, because the central bankers have kept yields and rates low for so long that they have to try to create more income for their clients. But yeah, leverage can be really great on the way up, but on the way down, it can be really, deadly to your fiscal or your financial health. So that's what's happening there. I think if you look at commodities as we have, if you look at fiscal policy, if you look at what Janet Yellen and the whole of the G7 agreed upon to go big, to increase fiscal spending even more, you have to understand these people don't believe in the free market. They're Keynesians. This is telling me that things are going to get really interesting in the hard asset sector, commodities, precious metals. And I think the Federal Reserve, of course, is going to try to keep yields from rising too quickly. But I think they might have a tough time. And I think looking at that chart there from Tavi about global negative yielding bonds. That's a worrying sign for the bond markets. A lot of people are complacent about the bond markets. They think that we can be like Japan for the next 10, 20 years, that yields are going to stay low or go negative, but I wouldn't bet on it. So there you go. I think it's going to get even crazier. We're going to get more and more rising prices of necessities. We're already seeing, commodity prices go up quite strongly. Things like copper, steel, lumber, food prices are going up. Of course, it's not showing in the government measures, and they probably won't show that much. But we all know that those government measures of prices, which they call inflation really, which is prices only, are highly doctored. And if you really want to know what the real rate of price increases are, or inflation as they call it, I recommend you go to shadowstats.com. John Williams, he keeps track of CPI, how the government used to keep track in 1980. And if they use that way of calculating CPI from 1980 now, it would be probably in the double digits, or 9-10%, maybe a bit more. So hopefully all of you have been protecting yourselves financially. Unfortunately, I think it's going to create a snowball effect. The Keynesians are going to see that people are probably the general public is going to have a tough time surviving in this environment. But they're going to double down. They're going to create even more stimulus. All that's going to lead to is currency debasement, which is not a good thing. The only people it benefits is the very wealthy and the government that has to write off the debt, because inflation and currency debasement writes off the debt. But the holders of the other side of the debt, the currency, they're gonna be left holding the bag, and the general consumer is gonna suffer a lot. Prices are gonna keep rising. So if you enjoyed this video, make sure you hit the like button. Please share it far and wide. Think about subscribing to my channel if you haven't yet. And you can also follow me on Twitter, Facebook, and all these other platforms below here. I wish you all a great weekend. Take care. Bye.